What's up? What's up? What's up? What's up? Let's share the screen, right? So let's share the screen. What's up? We're going to be talking today about types of investments. Okay. Why is this? Yeah, let's go. Okay. So what's up with you guys? What do you know about investment? So let's listen to this dude and teach us about
Most
investment.
people have heard that investing is the best way to accumulate wealth.
I guess you all have had that. Investing is the best way to accumulating what? Wealth. To accumulating wealth. Investing is the best way to accumulating wealth, right? So let's go there.
Investment is the act of redirecting resources from being consumed today so that they may create benefits in the future.
Mm,
More precisely, investment is the use of assets to earn income or profit.
mm.
The wealthiest individuals in the world became wealthy through successful investment of their assets. Let's go over the basics regarding common ways that people invest. Stocks and bonds are
I know you guys are all familiar with stocks and bonds. So, what do you know about stocks? What do you know about bonds? Let's try. Beautiful thing about this video is that I try to break everything down for our
two of
good.
the most common forms of investment. A
Mm,
stock is a representation of ownership in a public company. They can be risky to purchase as their prices can change dramatically and unpredictably, but
mm. Prices can change, and sometimes prices can just stay the same for a very, very long time. Uh, Sometimes it gets frustrating, but once you master it very well, you know when to go in, know when to go out, and you know where to put your money and where not to put your money.
often the bigger the risk, the bigger the potential reward. There are two ways for stockholders to make money: dividends and capital gains.
Dividends and capital gains. I love dividends. I love capital gains also. So let's pay attention. Okay.
Dividends are profits paid out 4 times a year to all shareholders.
Hmm.
The size of the dividend depends on the profit of the company. Capital gains are when a stockholder simply sells their stock for more than they originally paid for it. If the stockholder made a profit, it's a capital gain. If they lost money, it's a capital loss. A market for buying and selling stock is called a stock exchange. Brokerage firms are businesses that help stockholders trade stocks and sometimes even deal out stocks. These days, anyone can easily access the stock exchange on their phone through apps that offer brokerage.
Yeah, there's so many apps in Nigeria. We have the Invest Nigeria app. We have the Zscres. We have the Bamboo. I think Stambik too. I think there's an insurance company, is it AIMS? Not AIMS. Oh, forgive me. If I remember, I'm going to let you guys know in the comment section, right? I think where's my phone? I have it somewhere. So there's so many investment apps um, that are approved by the government. Some of them are very, very solid that you can trust, reliable. So let's take advantage and start investing. Okay, let's continue.
Services. A bond is essentially an IOU issued by a corporation or by some level of government. When you buy a bond, you are loaning money in return for a guaranteed payout at a later date. Bonds are usually a more stable investment than stocks. There are three components of bonds: their coupon rate, maturity date, and par value amount. The coupon rate is the interest rate that a bond issuer will pay to the bondholder. The time at which payment to a bondholder is due is called the bond's maturity. A bond's par value, assigned by whoever issues the bond, is the amount to be paid to the bondholder at maturity. In order for investment to take place, an economy first must have a financial system, which is the network of structures and mechanisms that allows the transfer of money.
The big question now is, what is the financial system of your country? You know, we need to pay attention. We need to pay attention to how many of us really even follow finance news in our country. How many of us have even heard about all these things we're talking about? You know, it's very, very essential for everyone to be financially literate, and that's what we're advocating for people to learn about finance, to learn about investment, and to learn about all these things, to learn about bond, to learn about shares, to learn about dividends, to learn about capital gain, to master, not just learn, but to master. And I'm glad that this video is trying to summarize. If you, after watching this video to the end, I'm sure you start looking at investment like a pro, not like a beginner.
Between savers and borrowers. As we learned in the previous tutorial, when people save their money, they often are actually lending funds to others. Savers and borrowers may be linked directly through what's known as financial intermediaries. Financial intermediaries are institutions that help move funds from savers to borrowers. They include banks, which we learned about in the previous tutorial, but they also include mutual funds, hedge funds, and pension funds. A mutual fund pools the savings of many individuals and invests this money in a variety of stocks, bonds, and other financial assets. A hedge fund is a private investment organization that employs risky strategies that can often make huge profits for investors. In general, these investors already have tremendous wealth and are knowledgeable about investing. A pension fund is income that some retirees receive after working a certain number of years or reaching a certain age. In some cases, injuries may also qualify a working person for certain pension benefits. Employers set up pension funds by collecting deposits, and pension fund managers then invest those deposits in stocks, bonds, and other financial assets. In general, the best way to invest your money is to put it in a diverse range of securities. This reduces risk, especially when stock or bond prices drop. Therefore, people often invest some of their money in more risky ventures, but invest the rest in more stable funds. It is also better to invest money earlier in life. This is because one of the greatest assets is time.
Okay, let's talk about investing earlier in life. Imagine a teenager who started investing at the age of 18, and he understands the financial system very well. You understand compounding, you understand dividends, you understand reinvestment. Imagine you invested in company. Like I was teaching my students sometimes, I say the IPO for Tesla, for instance, when Tesla first came out, the shares of Tesla was less than $20. Imagine an 18-year-old invested, maybe just bought 1,000 units of Tesla and didn't touch it, because Tesla is one company that they don't pay dividends because they believe in capital appreciation. Okay, so I think Tesla currently, as of 2026, Tesla shares is selling for over $250. You bought something at less than $20 few years ago, and let's say the child is now 16 years. Imagine. So you multiply your, say, 1,000 units of Tesla, and you see that's why it's good for you to start early, because when you start early, you have the advantage of time. So please, guys, if you listen to my video, you're a teenager, you're a young person, master investment, master finance, and I guarantee you, you will enjoy financial freedom all the days of your life.
Time. The longer your money is invested in securities, the more it will grow. Put another way, you make more money on the money your money already makes. When investing money, it's important to consider the two types of interest, simple and compound. Simple interest is based on the principal amount of a loan or deposit. Compound interest is based on the principal amount and the interest that accumulates on it in every period. Thus, it can be regarded as interest on interest. Simple interest is only calculated on the principal amount of a loan or deposit. The formula looks like this. A equals P times the quantity 1 plus RT, where A is the final amount, P is the initial principal balance, R is the annual interest rate, and T is time, usually in years. Compound interest is calculated based on both the principal and interest accrued. The formula looks like this. A equals P times the quantity 1 plus R over N, raised to the nt power, where A is the final amount, P is the initial principal balance, R is the interest rate, N is the number of times interest is applied per time period, usually in years, and T is the number of periods elapsed. Let's look at an example. Say you loaned $10,000 to a friend and they agreed to pay it back in 5 years with an annual simple interest rate of 5%. After 5 years, the amount of interest you would get would be $2,500, as the total amount they would repay would be $12,500, which is the original principal plus the interest. Now say you loaned $10,000 to a friend and they agreed to pay it back in 5 years with an annual compound interest rate of 5%. Because you really want to make some money, you also make sure that interest is compounded monthly or 12 times a year. After 5 years, the amount of interest you would get would now be $2,833.59, and your friend would have repaid you a total of $12,833.59. This example serves to illustrate that compound interest is far superior to simple interest when investing your money. Whenever consumers evaluate an investment, they must balance the risks involved with the rewards they expect to gain from the investment. In general, the higher the potential return on an investment, the riskier that investment is.
The riskier that investment is. Pay attention, but you must master finance. The best. Read books on investment, read books on finance. Don't take your financial life lightly. The goal is to be fit physically, spiritually, financially, and otherwise. The goal is not to be fit in one aspect alone. So please understand finance, understand compound interest, understand simple interest, understand bond, understand the capital market, understand investment, understand money market, understand all this, and do not be a reckless spender. Do never be a reckless spender. Let's conclude the video now.
In the next tutorial, we will look at
Okay, so basic of investment in stocks, bonds, mutual funds, and types of interest. That's what we just learned now, and I believe that you guys have a little knowledge. I'll come again with some good videos for us. God bless. Bye bye. And please remember, don't be a reckless spender. Spend your money wisely. God bless. So I'm going to stop sharing the screen and we're going to go on this. So please, guys, simple, learn about money and your life will never be the same again. Thank you so much. God bless.